Okay, time for questions to Chris Thom. He's our expert on Know Your Options. He knows options inside and out. Here comes an email from our viewer Nolan in Vancouver. Nolan writes as follows: I've been watching all this volatility and trying to pick my place to get into some of these Mag 7 names that have been beaten up so badly. They've bounced pretty well so far, and I have to think that they will come back over time. I'm just kicking myself I didn't buy Apple when it was under 175 US. And it got there. If it got there again, I would buy it. Do you have any sort of strategy that could help me do that? So what he wants to do is buy Apple. We can put up a graph of Apple. Wants to buy Apple, strongly preferably, if it's less than 175 US.
Yeah, thanks for that question, Nolan. I wouldn't beat yourself up too bad. It did get below 175, but not for very long, and it was obviously a lot of uncertainty at that time. So right now, with the stock trading more like 195 or 196, you can just keep it pretty simple and say, look, you've already picked that strike. You've said this is the point that I want to get long this stock. So you can just go out, take a look at the options market. So I took a look in going out to July, so 2 months from now, you can sell the 175 put for about $3.75. So you are going to make that commitment that you just said in this email for the whole country to see that you want to buy this stock at 175. So if it drops below 175, you're going to be buying it. But for that, you're going to get paid $3.60 a share, $3.70 a share. And so, you're looking at about 2%. If the stock never gets back to 175, you're going to make 2% over a couple of months. And then maybe you don't have to kick yourself too hard anymore.
Okay, thanks for the question. A great answer from Chris. Let's go to another email. Tyler is in Vernon, BC. Tyler writes as follows: Hi there. I bought Tesla earlier this year at about $350 US per share. I want to get back to even and reevaluate things then. Is there a way using options I can get back to even faster?
Yeah, okay, so this is kind of a cool one here that we'll do. So you bought the stock at 350. It's obviously now trading around 280. So you can do what's called a 1-by-2 put spread, or call spread, sorry. So you are going to buy a July 280 call. That's going to cost you about $40 a share. So, that's obviously pretty expensive. You're already long the stock. And then against the stock and against that call, you're going to sell two $320 calls. So that's going to give you 2-to-1 upside between 280 and 320. So above 320, you're going to have an effective sell price of 360, and then at that point you can take a look at reevaluating your overall position at that point.
Okay, thanks for the question. That was a good one on Tesla and how that viewer might get back to break even. Let's go to David in Ottawa. He's on the phone. David, thanks a lot for calling. What's your question to Chris Thom?
Yes, good morning. Thank you very much for taking my call, and thanks, Chris, for being on the show. Great information. My question is not on a particular stock, but it's on a situation where if I have a stock and it gets called away, it's in the money, it gets called away, is it better, and if I want that stock back, is it better to outright buy the stock, or is it better to short or to sell a put option? And hopefully it's going to be a sign, so that way you could get the stock back as well. Your input, please, and I appreciate your information. Thank you.
Yeah, great question. Thanks for that. It's sort of dealer's choice on this, right? You need to take a look at where the stock is trading and decide what is going to be best for you. So let's use that in the money call option as the example. So you've sold a call, it's in the money. When it's getting to expiry, you can just let it go. You can let it automatically exercise and the stock will be called away, or you could roll that position. So you could buy back the call that you're short, sell a further dated call in its place, maybe at the same strike, maybe you move that strike price higher, and that will generate a credit. So your obligation to sell your stock remains the same, but you get paid more for doing that. If it does get called away, then take a look at the options market. So, if it's just slightly in the money, maybe you really want that stock and you want to sell a higher strike call, so you've got upside between where it's trading now and where it would be called away the second time. Or maybe you want to sell that put. If the option premium is high and you've got money in a non-registered account, then I would go ahead and sell the put. So really, in a perfect world, every time you sell a call, you get called away, and then you sell a put and get assigned. It's you'd be making a lot of money if that was what was happening. But really, it's just make sure you're selling that put and getting paid a premium that makes sense for you.
Okay, thanks for that call, David. Let's go to LBO in Maple, Ontario. Hi, LBO. What's your question, Chris Thom?
Hi, thank you for taking my call. Chris, I was thinking, what I generally do is I sell puts and try and just collect a premium and not get the stock. And I'm interested in United Health. And I was thinking of just doing it on the money or close to the money at 380 and doing something in about a year. Just wondering what would you think, either December or March, December 25 or March of 26?
So United Health is an interesting one where the stock has been hit pretty hard on a couple of occasions. Obviously, a pretty tragic event with that company. So going out that far is not something that we typically do, but by all means, it is a valid strategy. So looking at the stock here, it's at $388. You mentioned the March 380 put. You can sell that and collect $43. So that's, call it about 8% about 13% of the underlying price right now over the course of a year. That's a good return. So I don't see anything wrong with the strategy. For us, we might sell some shorter dated puts along the way and try to do it 2 or 3 times during that period. I think you would collect more. And then the one sort of word of caution just with what you mentioned was that you like selling these puts and you never really want to take delivery. So, you really have to be selling puts on stocks that you are comfortable owning and at that price. So, I'd make sure you're ready to incorporate United Health into your portfolio and then go ahead and pick your date and strike.
Okay, thanks for that question. Let's go to the phones again. Joan is in Richmond Hill, Ontario. Hi, Joan.
Hi, how are you?
Great.
My question is the stock Peter's Jewelry. P as Peter, D as Daniel. Mm-hmm. And I wonder this stock is what's the problem? Because in January, it's still running at $94. Since they got the earnings come at February 12 and falling from $80 to now is 50, today 54. Just 3 days ago. And they're still running $60. And doesn't matter the oil price jump or down, it's going down every day, $2 a day, and no deals. And the volume is very small sometimes and don't get about 20,000 a day.
Okay, so I'm going to jump in here, Joan. A great question. Now, this is a show about options, so I'm going to ask Chris if he's got any quick options thoughts on this stock sounds like a shareholder who's unhappy with the performance of the stock. And Joan, I'd invite you to give us a call sometime on Market Call and ask us about precision drilling on Market Call, and you'll get an answer more broadly on the company and its prospects and the share price. This is a show about options, so I'll just ask Chris briefly, any quick thoughts on what a shareholder who's disappointed in the performance of the stock might do here from an options point of view?
Yeah, so similar to the Tesla trade that I mentioned earlier, doing a 1-by-2 call spread, that can help to get you back to even a little bit quicker if the stock does bounce. Otherwise, selling some calls to generate some income would be good. And then, you know what, if you are a shareholder and you are fearful that it's going to continue to decline, then, you could look at incorporating a hedging strategy like buying some puts. The options on this are reasonably expensive. If you bought it at 90, it's going to be difficult to get you some income at that level, but, sort of a regular increase in the share price over time, you could generate some income on that.
Okay, we had a couple of good questions from Kevin. Those questions are going to have to wait for another episode of Know Your Options. We will certainly, Kevin, if you're watching, we will certainly ask those questions to you. In the meantime, we'll take a break, and when we come back, Chris Thom's top options ideas in the markets right now.